We'll continue on our financial statements on the profit and loss statement, and next we'll look at other income. And what we'll do with that, to keep it simple, we'll just look at it as a percent of total revenue. And you can see here it's about 1%. We do have some exceptional years where it could be negative, where it's other expense, maybe a charge off or something, and then other years where it can actually be quite high. So it's not an easy one to predict, but for this purposes I'm going to keep it simple and let's just say 1% of revenue. So I'll put that in here. All that I'm going to do in that case is take the revenue times the 1% divided by 100, or the 1 divided by 100, and that's going to get me to earnings before interest and taxes, or EBIT. Now the next thing we're going to do is try to figure out what our interest expense is. Well, how do we do that? First thing we have to do is we have to add up what was our amount of debt in the balance sheet. So if I look at debt on the liability side of the balance sheet here, what we can see is that overdrafts is one form of debt and long-term borrowing is another form of debt. We add these two together to get our total borrowing. Now, of course, some companies will borrow, let's say a company has no debt at the beginning of the year, but at the end of the year it borrows $10 billion. Then what you'd find is that the interest charge would only be for that last, let's say they borrowed in the month of December, they'd have an interest charge related to the $10 billion for 1 month, but the other 11 months they'd have no charge. Now, it's not oftentimes that it happens like that. Usually a company adds a little bit or reduces a little bit of their debt. But if that was the case, you'd want to do a time-weighted average where you'd say 1 divided by 12 for the month of December and multiply that times the interest rate, and then you'd do 11 divided by 12 times 0, which would be the interest rate because there wouldn't be any during that time. So you would get a time-weighted average. But to keep things simple, we just do a simple average, which is just in line 94. You can see my simple average just says average of the prior year and this year, and that tells us our debt outstanding. Then I can go back up to our profit and loss statement and look at our interest expense, and I can say let's divide that interest expense, which is AC 11 here, divided by the AC 94, which is our average borrowing. We multiply times minus 100 because it's a negative up here and we just want to see it as a positive down here. And we can see in this case McDonald's interest costs was about 4.4%, 5.1, and then 4.5. So the first thing we're going to have to do is just assume what would that be going forward. Well, if we did more analysis on this company, we may say that that's going to change over time. But for right now, let's keep it simple and put it there. The next thing we're going to do is we're going to look at our total amount of debt in relation to long-term debt only right now. And what we can see is that our long-term debt is this amount, 10,560, and therefore what I can do then is calculate an interest charge by using the interest rate I have here times this average debt outstanding. So I'm going to put right there, and so that's going to get me an interest rate in this case of the average. You can see I've got the interest rate, which is AF 95, which is 4.5, divided by minus 100 because we want it to come up as a negative sign here, times the AF 94, which is the average borrowing rate there, or the average amount borrowed. And so that will give me a certain rate, and in this case that rate's not much different than the prior years simply because we haven't changed much. We'll come back to the overdraft later when we'll talk in more detail about that. Now the result of that is that can get us to our next level of earnings, which is earnings before taxes. Now then we come down and calculate the company's tax rate. How do we do that? We just look at the amount of taxes that it pays relative to its earnings before taxes. So that would be AB 13 here, or taxes, divided by AB 12, which is earnings before taxes, times 100. That gets us a 30%, 26.7. Now in this case I'm going to make sure that this is actually a negative item down here, so I'm going to copy that over, and then I'm going to assume the same interest rate or the same tax rate here, and then all I'm going to do now is multiply my AF 12, which is my earnings before taxes, times my tax rate, which is the AF 96, 29.8, divided by 100. We'll use a minus there to make sure it comes up as a minus, and that gives us our tax rate, which we can copy over. The basis of that then gets us down to our net income, where we will stop.